ultimate weapon for steady monthly income and growth. The JPMorgan Global Equity Premium Income Active UCITS ETF, ticker JGPI. JGPI owns 234 premium global stocks. Top holdings: Johnson & Johnson, Southern Co., AT&T. How our portfolio would perform if we would invest $100 each month to JGPI. January 2025, I started with nothing and put in the first $100 into JGPI. Shares began accumulating. Every month after that, I added another $100 and reinvested every dividend at real closing prices. This is our monthly dividend bar chart. The huge green June bar shows our reinvested growth. Dividends are paid monthly and fully reinvested. This is how you build wealth. Unlike passive ETFs, I'm actively managed by JP Morgan's top experts who handpick undervalued global stocks and overlay smart derivatives, all to beat the MSI world while delivering premium income. Here's the secret sauce. We own quality stocks and sell covered calls on them. This generates extra premium income every month on top of dividends. That's how we hit that powerful 8.32% yield. Full monthly breakdown of my $100 DCA in JGPI. Dividends reinvested. The JGPI share price dropped 10.7% from January at $27.85 all the way down to $24.86 in December, which hurt the portfolio value. But here's the smart part. That price drop let my $100 monthly investments buy significantly more units through DCA. Lower prices meant more shares per dollar. Portfolio ended at $1,208.55. 2025 was mediocre for JGPI. Dividends kept you close to break even. No big loss, no big growth. That's exactly the income ETF trade-off. That's the full JGPI story. A $100 monthly DCA in 2025 gave steady income, dividends offset the price drop, and you ended close to break even with real cash flow. I'm Bull Barry, and I'm out.